The housing market's been a huge topic of conversation lately. And I think with the reduction in mortgage rates, kind of led by the Fed rate cuts and rate expectations over the next couple of years, it's created a really interesting market dynamic. So I'm excited to kind of dive into that with you today.
Yeah, exactly. Mortgage rates are finally down, off their highs by a considerable amount. And, just kind of taking a step back and looking at what the market's been like, it's been really since the Fed started raising rates, it's been pretty stagnant. You've had this supply demand issue where there's a low supply of homes. New home building hasn't been up to what we've needed it to be since '08, really kept up with the population growth. Additionally, you have all of these existing homeowners locked into these, really low rates, what we've been calling the golden handcuffs of a high 2s, low 3% mortgage rate. No one wants to give that up in the current market environment. So you've had very little supply met with, a lot of desire to buy homes out there, but not a lot of demand to really pony up in a 6-7% mortgage rate environment that, we haven't seen mortgage rates this high in my lifetime personally. But, in a lot of people, they've gotten used to these real low rates. So no one's jumping to go, rushing out to buy a home at a 7% mortgage rate right now. So it's really this supply demand thing where just both sides have vanished. And now it's just created a really stagnant housing market for the past year or two.
Yeah, I think it's really interesting because whenever you talk about having this huge contingent of homeowners under these low mortgage rates that are, like you said, locked into those mortgages, those golden handcuffs, keeping them from entering the housing market again, it really seizes up that supply side of the dynamic. But then also you've got huge numbers of household formations that are occurring within the United States, and these people need homes to go into. And like you said, since 2008, we really haven't had the supply coming online to keep up with these household formations. So that disconnect grows wider and wider really by the day. So we'll kind of continue talking about the supply side of that, but at least from the demand side, things are starting to get a little bit more palatable for new home buyers, for current home buyers, because that 30-year mortgage rate has declined from kind of peaked around that 7.2% range. It's down to just under 6.1%. So that's actually making the finance on houses at least reasonable for folks. I mean, if you're a new home buyer, you're not exposed to a current really low interest rate mortgage. You're just looking for something that seems affordable. For in recent history, the last 12 months to 18 months, it's been cheaper to rent versus to buy just because of that financing piece. But if you look at what a $600,000 house, what a monthly mortgage would cost under 7.2%, that's over $4,000 a month. And it's right around $3,600 a month at current mortgage rates. So you're talking about a 10% reduction in your monthly housing costs. That's pretty substantial. So as far as the short-term implications of what these lower mortgage rates are going to do, the housing dynamic, I think you're going to see more new home buyers eager to get into the market. It's going to be interesting to see how home prices react because now that the financing is a little bit more palatable, there's going to be more demand for homes. And of course, supply versus demand. If there's still not a lot of homes on the market, that means that those home prices are likely to start to edge up. And we'll kind of talk about this later, but I think anyone who's a new home buyer, now is not a bad opportunity to kind of get your foot in the door, get that first home that you've been eyeing. If you find something that you like, even if financing isn't as low as it'll be a year from now, 2 years from now, it's becoming more and more palatable, which is kind of a positive time to make that move. And as we always say, you can date that interest rate, but you're going to marry that home. So you can always refi in a couple of years, but if that opportunity passes by, you may not get another opportunity. So something to strongly consider.
Yeah. And so you talked about the demand side. I want to briefly touch on the supply side. Is we're finally up back into what's considered a normal range. We're at the very, very low end of that normal range with 4.2 months supply of homes out there. And so usually you have about 4 to 6 months supply is what's considered normal. So we're finally back into that normal range, granted at the very low end of it. But you can definitely see that really shows us that we're in the early innings of this process of the real estate market picking back up and getting some actual turnover in homes that we haven't really seen in a long time. And then moving on from that, the medium term dynamics, once we get past that initial potential bump in prices that you were talking about, is I think as the supply picks back up, the whole market picks up and there are a lot more transactions going on. You'll find a lot more people entering the market, a lot more existing homeowners specifically entering that market where they might trade their 3.5% mortgage for, okay, maybe somewhere in the mid fives doesn't look terrible, knowing again that they can refi in a few years and get, maybe not back down to where they had it, but back into the fours maybe, or even in the mid fives is not a terrible place to be relative to what we've seen over the past, year and a half. And so moving on from that, looking at the medium term, once the market really picks back up and mortgage rates continue to drop back to, maybe they're in the mid fives, low fives, all of those people in the golden handcuffs who are wanting to move are going to have that opportunity. They won't get the same mortgage rate they've had, but the new one won't be prohibitively expensive. And you'll just kind of have this like staggering approach while mortgage rates are still high, and they're coming down, the most urgent movers will move first, and then it'll kind of trickle on down that demand with mortgage rates, but you'll see a lot more turnover going on. And so while a lot of existing home buyers will be buying and selling a home, and you'll not have a huge increase in supply, granted, some of these people might be moving into old folks' homes or back into apartments or whatever their life, circumstances dictate, they'll be slightly increasing supply, but realistically, their main benefit is just increasing throughput, like how many homes can turn over. And as the market picks up and just more volumes, it's really going to help not only prices, but both buyers and sellers. And then finally, we're still going to need those home builders to continue building because the supply, as we've mentioned, is chronically low. It's chronically been behind since '08, which really, dealt a big blow to a lot of home builders. We lost a lot of companies through that. And so we just don't have the new home throughput that we had in the past that, anything to keep up with inflation, or not even inflation, with population growth.
Right. And I think that everyone's kind of contending with that. How do you create a better supply dynamic for the housing market? And unfortunately, there's not really an easy answer there. You can talk about government incentives, but you don't want those incentives to be on the buyer's side because that's just going to create more demand, which we already have plenty of. You really want to incentivize that supply side. Maybe that means tax breaks for home builders or something to stir up more of the supply coming online to satisfy all these household formations. I think going back to what you were saying about this intermediate period where people are thinking about exiting their home, I think it's also pretty important to note that these individuals with these low interest rates, these low mortgage rates, they've been building a lot of equity in their homes over the last 3, 4, 5 years just because they're paying very little in interest. A majority of that loan is going to principal. And so whenever they're out in the market thinking about a new home, unless they're upgrading super substantially and it's going to be a much higher priced home, they have a lot of equity to use to roll into that new home if they choose to, which makes that financing piece a lot easier. So I think that's an important dynamic to consider. Also, if you're talking about new home buyers competing against those individuals with lots of equity, it may be a good time to get out in front of those individuals, because if you're up against somebody who's already built $100,000, $200,000 of equity in their home, it's gonna be a lot harder for you to justify whenever you're paying that first down payment of 20% or so, and then doing the financing on top of it. So I think that's a dynamic that everyone should really be paying attention to.
Yeah, and I think there are a few risks to the lowering of home prices as far as, as time goes along. You talked about that short-term kind of bidding war between new home buyers and existing home buyers who do have a lot of equity built up. And so that allows them to more easily, outbid people or just get better terms and be a better, borrower from the bank to begin with. But also there's the phenomenon where people, when you're looking for a house, you're not really looking at a specific price. You don't have $600,000 in the bank and that's my home budget. Is you're looking at what it would cost you every month. And so people usually budget based on their monthly expense of the home. And so as mortgage rates come down, there will be a little bit of pressure pushing those home prices up because now people can afford a little bit more. If at 7%, you can only afford a $500,000 home. Now you're looking at, $600,000 homes. And this one's a little bit nicer. Maybe I can make a $650,000 home work in my budget now. That wasn't a concept earlier for you.
And I think it's also important for our listeners to note that just because you're paying a higher price, it doesn't actually necessarily mean that the quality of that house is higher. It may just be that same house at a higher price this time. So it's important to really look at the market and think about the fact that just because the monthly payment is lower and it's paying for a higher price house, make sure it's also a higher quality house if that's going to be the case too. And I think as we conclude this episode, it's important to think about mortgage rates in general. We're not going to go back. Unfortunately, we're not going to go back to this 3% mortgage rate range. Sub 4% mortgages, we probably won't see those for a considerable amount of time. The Federal Reserve, as far as rate policy goes, is not looking to bring rates back down to zero. That's only really going to happen under a serious kind of recessionary scenario, in which case the market's not going to feel good for anybody looking to buy a house, especially for laborers, for people in the job market, if a recession has just hit. So understanding that, yes, all those people, all your friends who have those 3 or 4% mortgages, they're sitting pretty, they're lucky. You're not going to see that for some considerable amount of time. Or that goes for people who currently own a home and are looking to move. They're not going to get the same financing costs. So you kind of have to resign yourself to that fact.
But I think that's just another feather in the cap of marry the home, date the mortgage, because, you can sign up for a 6% mortgage rate right now. Maybe you get somewhere in the 5s. Well, if that economic, catastrophe or even just a mild recession were to happen, the Fed cuts rates pretty hard to, counteract that. Well, now there's your opportunity to refi the home you already live in and lower those monthly payments during those hard times.
Absolutely. And I'd say to our listeners, if you have any questions about the housing market, if you want to hear more about this, drop us a comment. We're happy to give you some feedback on that.
Thanks, Victor.
Thanks.